Hello trade pros. Did you know that the 10-year and 2-year yield spread has predicted every major recession in the last 40 years? In today's video, I'm going to show you how to create your very own yield curve using a free charting platform called TradingView, and more importantly, how to apply it as a forecasting tool for your trading and investing. Let's jump right into it.
First thing I want to talk to you about is what is a bond yield to begin with. The importance of a bond yield is that it's an instrument the government uses to finance their operations and their budget. So what the government will do is sell bonds with a guaranteed maturity that pays out a regular series of payments on an annual basis. This is called a coupon. So every bond has what is called a yield. The yield is a percentage that you earn on the money that you lend to the government. At the end of the bond, at the maturity period, you get a return of your capital in full, and your profit was the regular series of payments throughout that time period. The bond market is many times the size of the stock market, and these bond yields are very closely followed by traders and investors alike. So in today's video, I want to spend some time and look at the chart now and talk to you about how to create your very own bond yield. The first thing you're going to see that I have on my chart is several different lines, and this is just simply a comparison tool on TradingView. If you're interested to learn how to do market correlations and comparisons, we have a great video that I'll link to in the description on YouTube, and we show you how to do that on TradingView. But for today, what you're looking at is a series of lines. The lightest one represents the shortest term yield on the 2-year bond. The slightly darker one is the 5-year bond. The darker one than that is the 10-year. And lastly, the very dark black line is the 30-year yield on the bonds. When you look at the bottom, the green is the S&P 500. So this template allows me to have a quick look at bond yields and how they're doing over the different maturity periods. Now on the right side is the chart that I'm going to show you how to create, and I'm just going to expand it for now, and I'm going to show you this. Very simply, to create a 10 and 2-year bond yield, you go on TradingView and type the following: US 10Y, and that means US 10-year government bond, and you'll see the symbol will appear, minus US 02Y, and that's the US 10-year government bond. This is what's referred to as the 10-2-year spread. Now when you're looking at the 10-2-year spread, one thing you want to notice right away is what is the typical trend. And if we go on a weekly chart, you'll notice that these yields stay between a range of about 2.8% or 280 basis points. When bond yields are quoted, every single percentage point is a 100 basis point move. 1/100th of a percent is equal to 1 basis point. So as you can see here on this chart, in 2009, in the housing bubble collapse, bond yields spiked to a high of 2.8 or 280 basis points. And if you zoom out on this chart, you'll notice that this yield curve, or the difference between the 10 and 2-year bond yields, have stayed between the 0 range for the most part and the 2.8 or 280 basis points. We tend to navigate between this low and towards the high, sort of like a support and resistance. Now another thing you'll notice is that when you compare it with the S&P 500 market, and I'm just going to add in an XPX 500 comparison to bring the market on here, you will notice that the bond yields move inversely or in a negative correlation to the S&P 500. That is, as stocks rally, bond yields drop, and as stock markets drop, bond yields go up. The reason for that is because market money is flowing out of equity or fear assets and looking for safety or guaranteed coupon payments, which is what bonds are. So if we now look at this and we remove the S&P 500 for comparison's sake, it's time to ask this question: at what point does the 10-2-year spread start to signal a recessionary pressure? Well, one thing you're going to notice is the lower that it goes, the more likely the S&P 500 is to rally. That's the inverse correlation relationship. When we get to the negative territory in that chart, when we drop below 0, what this means is that the 2-year bond is actually paying you a similar amount as a 10-year bond. And why is that trouble? Think of yourself as an investor. You're earning the same amount of return on a 2-year commitment as you are a 30-year commitment. Which would you prefer? Obviously, most investors would rather have the same earnings as a percentage over a shorter period of time, because then they could reinvest and have more opportunity down the line. So as the 10 and 2-year yields become negative, this means that investors are not trusting the government by lending them money for longer, and that they're not being compensated for it either. So there's more demand piling into the 2-year while there's less demand coming out of the 10-year yield and bonds. So when these yields invert and cross below zero, it starts to become a prediction for an upcoming recession on at least a medium to major level. And if you look back at this time, you could see that going up into 2008, 2009 housing bubble collapse, bond yields dropped below zero and traded to as low as minus 0.2, so negative 20 basis points. In 2001, preceding the In 2001, preceding the dot-com bubble, you could see that we had the 10-2-year spread go all the way down to negative 94 basis points. And before that, in 1990, the early recession of the 90s, it dropped to as low as 0.47 basis points on the 10-2-year spread. Now, where we are in today's movement and the economic cycle, it's now 2018, and we're in the middle stages of 2018, and although these 10-2-year spreads and yields have not hit a negative number, we are in a rapidly declining trend. There's a lot that goes behind this, including Federal Reserve accommodation and these interest rates, but more importantly, what it's starting to signal is that we may be topping out in the equity market, and this 10-2-year spread is starting to give us a look at a potential early signal of an upcoming recession. If we slip below zero, that becomes super important, and that's going to be the trigger for many institutional investors and traders to start taking money off the table from equities, which are risky assets, and putting that money towards risk off or safety assets, which is bonds. And that's going to be the trigger, that 0 point. Keep a very close eye on this 10-2-year spread, because once we cross zero, it's going to give us an accurate prediction of a recession. In fact, every single time we've had a recession in the last 40 years, this 10 and 2-year bond yield spread has been negative first. So while at this moment we're not squawking the bell on the recession, this is something you absolutely have to keep an eye out on as a trader. Definitely if you're a fixed income markets trader, but even an equities trader, commodities, Bitcoin, or any kind of investor trader, because this is a super accurate and powerful predictions for recessions. Right now we have a flattening yield curve and we have a negative trend in the 10 and 2-year spread. However, the real key point and the trigger becomes that 0.00 marker, and it's been very accurate in the past. So there you have it. That's a nice little overview of how to use the 10 and 2-year spread on bond yields, and I've showed you how to create your very own comparison chart on TradingView. If you want to learn how to make that chart, once again, there's more details in our stock market correlation and comparisons video on TradingView, and that link will be in the description below. Or you could look to the right on YouTube and see the replay. That's all for today. Implement this into your trading strategy, and I would love to hear from you if this was helpful and how you plan to use it for your own investing and trading. Thank you so much, and I hope this has been very helpful.
All right, trade pros, and there you have it. I hope you've enjoyed this video and you now know how to use the 10 and 2-year spread in order to forecast stock market movement and price action. This is a great tool to have in your toolkit, and remember to use it sparingly, and that it tends to predict a longer term overall trend. The timing of those market reversals are still prone to some more of the intraday trading behaviors that you could learn more about in our futures day trading course. I encourage you all to head over to our website. The link is below in the description, and you can find out how you could get a risk-free trial of our trading platform and development education. Thank you so much for tuning in. Please comment, like, share, and subscribe. And when you do subscribe, be sure to ring that bell so you receive notifications every time we have a new video that comes out. We're live every single morning, Monday to Friday at 9 a.m. with a pre-market report. We'll see you guys there. Thank you for tuning in, and have yourselves a great day. And remember, manage your risk and trade like a trade pro. Goodbye.